Hey traders, and welcome back to another episode of Smart Risk. Understanding liquidity and knowing how to read it correctly is one of the most important skills any trader must master to survive and stay profitable in the markets. If you can't read liquidity the right way, the market will constantly trap you, no matter how good your entries look. That's why in today's video, I'm going to break down 4 advanced and essential liquidity hacks that will completely change the way you see price action. These are the exact concepts professional traders use to stay one step ahead of the market, instead of getting trapped by it. By the end of this video, you'll understand how liquidity actually works, how to read it in real time, and how to trade with smart money instead of against it. We always appreciate your support, so please give this video a thumbs up and subscribe to our channel if you are new. See you after intro. Welcome back traders, so let's get started. Hack number 1. Identify the trading range before you analyze anything. The first thing is simple. Before anything else, you need to identify your current trading range. So what do I mean by trading range? A trading range is not just a box or a consolidation. It's the area where price is currently operating and where liquidity is being built. In simple terms, it's the zone that gives us the most information about future price direction once the price breaks either side of it. And as long as the price is inside this range, we need to carefully monitor the price action. So, how to identify your current trading range? The first step is to zoom out at least 1 or 2 time frames higher than your entry time frame. For example, if your entry time frame is 1 minute, define your range on the 15-minute time frame. If you trade from the 5-minute, look at the 15-minute, 30-minute, or 1-hour time frame. If your entry time frame is 1 hour, your trading range should come from the 4-hour or daily time frame. And this is critical. Never define your trading range from your entry time frame. To define a valid trading range, you must locate the last valid and confirmed break of structure impulse leg. For example, in this chart, this break of structure is valid because before the price pushed higher, it retraced into the discount area, tapping below the 50% Fibonacci level and triggering resting buy orders. Now we focus on the impulse expansion leg that caused this valid BOS. Once price later pushes below the most recent internal low at the premium area, which acts as an inducement, it confirms 2 things at the same time. That the bullish expansion leg is complete, that this swing high now marks the upper boundary of our trading range, and this is how a valid trading range is formed. You might ask, why don't we consider this single impulse move from this swing low to this swing high as our trading range? Here's the reason. If you draw a Fibonacci tool from the swing low down to this swing high, you'll notice that price never retraced into the 50% level of this impulse. That means none of the discounted buy orders were triggered. Because of that, this move is not a valid BOS. This breakout is fake. And this range is not a valid trading range. This retracement is nothing more than a temporary pause while price prepares to complete its real impulse leg. For a trading range to be valid, the price must break below the most recent internal swing low, the inducement, confirming that the bullish expansion is finished. Only then do we have a real trading range that we can rely on. Once your trading range is properly defined, you stop chasing breakouts, you stop buying highs and selling lows, you stop guessing direction. Instead, you wait for confirmation such as liquidity sweeps, inducement, a shift in delivery. And this is where real high probability trading begins. Now that we've identified our trading range, the next hack is understanding where liquidity actually sits inside and outside that range. Once you understand external and internal liquidity, you stop asking, is price bullish or bearish? And instead you ask, which liquidity is price targeting first? That question alone changes everything. Let's start with external liquidity. External liquidity exists outside the trading range. You'll typically find it above major swing highs or below major swing lows, exactly where retail stop losses are resting. These are the areas smart money uses to manipulate the price. Your trading range high and trading range low are the most important external liquidity levels you need to pay attention to. Why? Because they're the closest external liquidity pools to the current price, and price is far more likely to target one of them first before doing anything else. Keep this in mind. Most market manipulation happens around external liquidity levels, especially around major session highs and lows. You can think of external liquidity as one side of a magnet, but a magnet always needs two poles. The other side is internal liquidity. Internal liquidity exists inside the trading range. This is where most of the real action happens. This is where inducements are created, traps are set, and positions are built before the real move begins. Internal liquidity usually appears in the form of fair value gaps, volume imbalances, liquidity resting above or below internal swing highs and lows, trend lines inside the range, consolidations that form within the trading range. In simple terms, internal liquidity refers to all liquidity located inside the current trading range. And here's the key point. Internal liquidity is not meant to be the final target. It's meant to be used. Smart money constantly uses internal liquidity to fuel moves toward external liquidity. And that's exactly why you need a solid understanding of it. The interaction between internal and external liquidity is what drives the market's main algorithm. So if you want to understand how the market really works behind the scenes, you must understand dynamic liquidity. And this brings us to the third and most important. Internal and external liquidity together form the market's dynamic liquidity. This is the real engine that drives price, pushing it higher, dragging it lower, or faking traders out along the way. Dynamic liquidity explains how liquidity flows through the market. Think of it as a loop. Price is constantly rotating between internal liquidity and external liquidity. It's either moving from a high or a low toward a fair value gap, or from a fair value gap toward a high or a low. This rotation is the core rhythm of price movement. Once you understand that rhythm, everything changes. You stop fighting the market and start trading with it. Dynamic liquidity is the force that pulls price forward. And that insight gives you a powerful edge in anticipating direction and timing the next move. Inside a trading range, price usually moves first toward internal liquidity. That internal liquidity can appear as internal highs or lows, or as fair value gaps. As price approaches these internal targets, inducement forms. And once internal liquidity is swept, or the imbalance inside the fair value gap is filled, the market shifts its focus outward. At that point, price starts searching for the next pool of external liquidity to expand toward. And when that happens, old liquidity is removed, new liquidity is created, and price becomes drawn toward a fresh external target. That new draw is dynamic liquidity. So if you're buying or selling inside the range without understanding this process, you're most likely doing one thing: providing liquidity, not taking it. This process repeats over and over on every time frame. Once you understand dynamic liquidity, you stop holding trades too long. You stop targeting invalid highs and lows. You stop forcing bias. Now here comes the real challenge. You might ask, how do we predict where the price is heading next? Will it move higher to sweep upper external liquidity, or drop lower to grab lower external liquidity? To answer that, we need to focus on how price behaves when it enters fair value gaps within the trading range. This is where direction becomes clear. If price enters a fair value gap, respects it, and especially respects the midpoint, while showing signs of rejection to the upside, it strongly suggests that price is preparing to move higher, targeting the upper external liquidity. On the other hand, if price disrespects the fair value gap, meaning it breaks straight through it with no meaningful reaction, that gap flips its role. It becomes what we call an inverse fair value gap, now acting more like a resistance zone. And if price then retraces back into that inverse gap and respects the midpoint this time, showing clear rejection, that's an early and powerful sign that the market is likely to continue lower, aiming to sweep the external sell-side liquidity resting below the trading range low. Now, what happens if we have healthy and efficient price action inside our trading range, meaning there's no internal liquidity left to be addressed? How does price behave in that situation? As we mentioned earlier, price normally rotates between internal and external liquidity. But when internal liquidity is absent, when price action is clean, balanced, and efficient, external liquidity becomes the only driver of price movement. In scenarios like this, price begins to move directly between buy-side and sell-side liquidity. It targets the major highs and lows, where stop orders are most likely resting, cycling from one external liquidity pool to another. This back and forth movement continues until something changes, until a new inefficiency forms, a fair value gap appears, or a new inducement develops. At that point, internal liquidity re-enters the equation, and the full liquidity chain is restored. Now that you understand dynamic liquidity and how price is driven inside a range, the next important hack we need to cover is the liquidity sweep. A liquidity sweep is all about one thing. Price takes liquidity above or below a key level, then immediately closes back inside that level's range, and from there, it drives price toward the opposite side's liquidity. For example, if price sweeps a key buy-side liquidity level, we expect price to shift direction almost immediately and move towards sell-side liquidity at the opposing key level. This is one of my favorite liquidity models, because the market does this every single day, and it offers one of the best opportunities to build a clear trading plan and align yourself with institutional money instead of fighting it. There are two main types of liquidity sweeps. The first type is a sweep of key external liquidity levels. These are the highest probability sweeps, and the ones we always want to focus on trading. The second type is a sweep of internal liquidity levels. These are much lower probabilities, and this is where most traders get trapped by fake moves and inducements. High-quality liquidity sweeps most often occur during high-volume time windows, typically right before or right after a major session opens. For example, here you can see that right at the session open, price makes a fake push to the upside, sweeping the liquidity built above the Asia session high. But immediately after clearing the buy-side liquidity, the price reverses sharply in the opposite direction and takes out Asia's low as well. So in this sequence, price sweeps both buy-side and sell-side liquidity, and then continues in its intended direction. If you look closely, you'll notice that price does the exact same thing at the New York session open. Price pushes above the London high, sweeps the buy-side liquidity resting there, and then immediately shifts direction toward the next key sell-side liquidity, which is the London low. From there, the market finally delivers the true move that smart money planned from the beginning. Now, we also have liquidity sweeps that occur at internal swing highs or lows inside a trading range. These are not real liquidity sweeps, and most of the time, they lead to low probability trades. The reason is simple. The most important liquidity always sits above or below the high and low of the trading range. Because of that, price is far more likely to target external liquidity, not internal swing points. So our focus should always be on liquidity sweeps at key external levels, not just any internal high or low. There is one important exception that can create a high-quality trade opportunity. If price sweeps internal liquidity right before tapping into an unmitigated fair value gap on the opposite side, that significantly increases the probability of a sharp move toward the next external liquidity pool, especially when it aligns with the higher time frame trend. This is where internal liquidity acts as fuel, not as the final target. That's it, traders. Thanks for watching. I hope you found this video valuable. If you did, hit subscribe and turn on notifications so you never miss an update. Drop a comment below with your thoughts or topics you'd like to see next. Your support means the world to us. See you in the next video.